Great. Well, thanks again, Andrew, for that. Really appreciate it. And what we're going to do is we're going to switch over to Tyler. And Tyler, we did a trail run, and you have your quick study, so you know what you're doing with Google Meets and sharing your screen, and would really like to get your insights on what you're doing relating to risk mitigation and some of the things you're seeing as well that you'd like to share this morning.
Yeah, for sure. Here, let me just tee it up for you folks. There we go. Everyone see that first slide all right?
You're good.
Okay, perfect. Well, yeah, I got a grains and oilseed outlook prep for you folks, then some forward-looking guidance, some targets on the canola and the wheat as well too. And yeah, I'll keep it quite open. Obviously, I don't mind questions in the slightest, so we'll get going from there. Make sure this actually cycles through. Did my slide cycle through before I get started there?
We're happy.
We're good? All right, perfect. So like I mentioned, I'm going to talk a little bit about the tariffs. We'll talk on the Canadian dollar and US dollar as well too, and then I'll jump right into kind of the meat and potatoes of the presentation on the corn, beans, wheat, and canola. So obviously for anyone on this call, the tariff news that's been going on back and forth is no surprise to anybody, right? We're continually getting bombarded with headlines, a lot of the time, contradictory to one another, right? If you look at how much has happened in such a short period of time, we have had some huge swings in what the tariffs were originally going to look like, what they look like now, and what they could end up looking like in the next 90 days or so. And we're seeing that volatility play out in the markets, not only on the macro side of things, but also on the grains and oilseeds as well too. So bit of a recap of where we currently stand right now, and I kind of joke that I got to be updating these slides almost hourly sometimes on this part, but on Canada's side of things, there is a 25% tariff on all autos and certain auto parts, 10% tariff on energy and potash, and it took effect midnight on April the 3rd. Now, I put this second snippet in there intentionally because this is taken directly from the White House website, and even though it has been laid out what the tariffs are, there is still a lot of ambiguity and room for interpretation because of, I'm trying to think the best way to put this, but the messaging and the wording hasn't been super clear, even with everything going on. So the way it reads on the website is that the exemption on USMCA goods and tariffs of 25% on non-USMCA compliant goods and 10% on non-USMCA compliant energy and potash were unaffected by the recent reciprocal orders. So that does leave a little bit of ambiguity on what is getting affected with goods going across the border. But from our best of our knowledge, it is anything that was currently USMCA compliant is fine. It continues to go across the border with no tariffs, with the exception of the auto parts that were mentioned and the energy and potash. As well as that too, the US put 25% tariffs on Canadian and aluminum and steel that remain in effect right now. So although this is definitely, detrimental to specific industries, it was a lot better than what was initially thought Canada could fare when all this tariff rhetoric started going back and forth. It took our tariff rate, our effective tariff rate, to 3.5% from about 2.5% previously. So the focus going forward now is going to be, what does the rest of the world do in retaliation or reciprocation or any type of trade deals that come from this? So there has been obviously a lot of countries reaching out to the Trump administration, looking to negotiate deals. And this was part of the reason that we got that supposed 90-day pause that we're in right now. The only country that was exempt from the 90-day pause was China, because they retaliated with 34% tariffs on all the US goods, and this went into effect April 4th. Now, since then, their tariff rate has actually risen to 125% on the US, and the US has raised theirs on China up to 145. We've basically seen over the last 2 weeks a continued back and forth tit for tat on raising the tariff rate. Now, we did get some news here over the weekend that it sounds like some electronics, cell phones, and other type of computer parts out of China are going to be exempt from the US tariff rates. So at least this is one, positive headline out of all this back and forth. Doesn't mean they're anywhere near negotiating a deal. Unfortunately, probably not, but hey, at least it's one small step in the right direction. So let's look at our currency pairing here, the Canadian US dollar. If we were to step back and ignore all the tariff news, one of the biggest drivers of what I'm going to call fair value of our currency is interest rate differentials. So basically the difference between the US federal funds rate and our Bank of Canada rate. Now, because the market is always forward looking, it's actually correlated best to where we think interest rates are going to be in about 2 years' time. So what I've got on the chart here on the blue line is the difference between the Canadian 2-year bond yield and the US 2-year bond yield. And then the red and green that you see is the Canadian dollar value. So as you can see, up until about, the start of mid 2024, that correlation was very, very strong. Now we've seen that correlation break down over a number of months now, basically since early 2024. And the reason for this is that once we start moving below the 70-cent level on the Canadian dollar, we usually have a very hard time staying down here. And there's a couple of reasons for that. And the main one is that we get this phenomenon called importing inflation. So we are an exporting nation, right? So if our currency continues to devalue, all of a sudden, all the goods that we're exporting become more competitive in the rest of the world. That helps to drive up our GDP if that persists for a longer period of time. As well as that too, when we're importing anything, when we have a low dollar, it gets very, very expensive. That also starts to drive up our inflation levels. And if this persists for a longer period of time, the central bank is forced to raise rates. It narrows that bond yield spread extremes that can shock us below that 70 cents, right? We saw that back in 2020, we saw it back in 2016, and obviously we saw it here at the start of these tariff announcements. But it's the ability to persist down there that is very, very difficult because of these reasons. The other thing that we've got to watch very closely going forward is the path of the US dollar. Now, interesting enough, the US dollar index is actually following the path of Trump's last term. So back in 2016, when Trump was elected, the US dollar rallied all the way up until about inauguration. And ever since then, it fell all the way into the end of the year. Well, we've actually seen the exact same pattern happen to the US dollar this year. Obviously, some of the tariff announcements and everything like that has been negative, this US dollar. But even when we strip that away from it, typically speaking, a lot of Trump's policies tend to support an outlook for a lower US dollar index, right? He's constantly harping on the Fed to cut interest rates. He wants to be an exporting nation. He wants this US dollar lower. So I think we're seeing some support in our currency here and can continue to see that just from the fact that we've got to trade essentially the inverse of the US, and a lot of their policies are going to be US dollar negative. So switching on to the oilseed side of things, talk a little bit about soybeans and canola. So from a tariff point of view, soybeans obviously carry probably the biggest exposure to any, further tit-for-tat retaliation tariffs. 42% of total soybean use in the States goes to the export market. And this year, 49.95% of that has gone to China. Now, we're in a bit of an interesting time of year right now because the soybean market has held out very, very well despite all this tariff news back and forth. And that's because this is not the time of year that China usually buys US beans, right? The Brazilian crop is basically all harvested right now. They're the main supplier of beans into China. So we're not losing any demand that we would normally have this time of year. But what we've got to be careful with going forward is that if there's not some type of a trade deal, before late summer into fall, that's where China typically comes back to the US as a soybean buyer in a big way. And if they're still having these, tariffs back and forth, that could be where we start to see some loss of demand and where there could be a relation to some negative soybean prices as well. From both a US and world point of view, we continue to see supplies grow. Ending stocks have been growing slow but steadily in the US, but they've been taking off much more in the world market. World ending stocks are projected to be about 7 million metric ton above last year's record. This is also building in an additional 31 million metric ton of additional use. So the way I like to look at that is that, realistically, even if we have some crop hiccups throughout the year, we've got about 31 million metric ton of soybean wiggle room before we start to contract world supplies below where they were last year. This doesn't mean it's an environment that soybean prices cannot rally, but it's something to keep in mind when if we see a weather shock this year in the States or somewhere else or anything like that, to how big that shock has to be before we put ourselves in a position that we're drastically tight. So we can obviously still see some bullish price movement, but we're going to have this, big supply chunk overweighing this market, which might just keep that upside a little bit dampened compared to other years. So obviously the big driver in world supplies, again, this isn't going to be a surprise to anybody here on this call, but has been Brazilian production. You can see on that chart on the left that even with the odd weather hiccup here and there, for the most part, they continue to grow larger and larger crops every year. They're expanding their acreage base, their technology is getting better, everything like that. And that's a trend that we do, think is still going to continue over the years to come. So because of this, we're seeing their export share continue to grow. Their exports have been growing pretty steadily over the last 4 years. We are seeing more domestic consumption of beans in Brazil, which maybe steals a little bit from the export market, but it likely still sees that export share grow in relation to the US. So because of this, when we look at price determination for soybeans, the market really has to start stepping away from only watching what happens in the US to paying attention to what's happening in the world and our price competitiveness, right? Because such a huge chunk of our soybean demand still relies on exports. We got to look at the basis differentials between the rest of the world and the US to see how, where price upside could be. So as you can see from this graphic right now, we're still relatively competitive in that world market. But if we see that Brazilian basis start to drop, even if we have some issues back at home, it's going to be something that keeps a little bit of a weight on our prices. So this relationship is something that's got to be watched very, very carefully, especially into this spring and summer. Because if we get some type of weather rally and our prices jump, but the rest of the world doesn't, this is going to be key to watch to try to gauge how high can we go before we've hit a top. On the domestic side of things, crush continues to remain strong. Again, you can see pretty clearly from that chart that this has been a growing industry for a number of years. It's expected to see continued growth into next year as well, too. So it's really been the bright spot on the demand driver side of things. So from here, where does that set us up for the new crop marketing year? So we got our March 31st planting intentions report back a few weeks ago, and it pegged the 2025 projected acres at 83.8 million bushels. So if we plug in a trend yield of 52 bushels to the acre and we leave demand unchanged, it's going to give us a slightly tighter carryout year over year of about 347 million bushels. Now, I always say this carefully, but demand is going to be a wild card because we're talking about demand for a 12-month period that doesn't begin for another 4 to 5 months. So I really think that making huge changes to demand at this time of year is very, very difficult to justify until we see where prices are closer to the time. But two things I would like to watch very closely is where this demand forecast could change is the fact that I wouldn't be surprised to see crush come in a little higher again year over year. We've continued to expand that capacity, and I think we're going to continue to see that as well. The one we've got to be careful about, though, and would probably offset any increase in crush would be exports. Brazil pulled off a very, very big crop this year. Obviously, the year before, they had a little bit of weather-related issues, and that helped the U.S. pick up some more exports this year. I don't think we're going to see that same demand for U.S. soybeans in the fall that we did this year. And as well as that, too, if there's any continued tariffs in place at that time, that could hurt that export forecast. But again, it's going to come down to those price spreads and our competitiveness in the world, and that's going to be pretty tough to project from now. But something to keep an eye on of where that demand could change longer term. So if we look at that ending stocks estimate, where does that put us in historically, right? So obviously it puts us pretty near where we've been the last 2 years, but it also puts us in a similar position that we were back in 16 and 17. And if we look at the ranges for those last few years, you can see that it gave us kind of a floor around that $9.50 mark and a ceiling at $12. Now, $9.50 to $9 is probably getting a little bit on the low side of things, given the state of the renewable fuel industry in the States. And I like to make the comparison to ethanol, right? When the ethanol boom happened in the US, old $3 high corn became the low. It was a dynamic changing for the industry. I think we've seen a similar transition in those beans with the massive move in that renewable fuel industry. So I think $9.50 to anything below there is going to be pretty tough to get unless you have some big policy shocks. On the flip side, $12 beans, we're going to need some type of weather rally or weather scare to get us there. I don't think it's impossible, but again, know what it's going to take to get us there and reward it if we get there. So switching gears a little bit and just talking about policy here. So I put together this graphic just as a bit of an oversimplified version of how the renewable fuel program in the States works. So on the left, you have renewable diesel producers, right? They obviously buy feedstock, they buy the soy oil, they turn it into renewable diesel, and they also produce these things called RINs. On the other side of the equation, you have the refiners. They are mandated to blend a certain percentage of their fuel with renewable diesel. If they don't do that, they're then required to buy RINs to offset their obligation. That blending mandate is set by the government and is taken as a portion of total fuel demand. So the issue that we have run into in the States over the last few years is that it's not profitable for these refiners to blend renewable diesel into their mix. They only do it because they're obligated to do so by the government. We've seen a massive growth in the capacity of renewable diesel production in the US, but the blending mandates have not kept up. So what that has caused, it's caused a lot of plants to start running below that 70% capacity utilization. It's caused RIN prices to fall. It's caused pressure on the soy oil and the feedstocks, and it's caused expansion plans in that renewable diesel capacity to start to trail off, right? Look where we were in 2021, all the way up to 2024. We're pretty well flat now going forward. If we look at the mix of feedstocks into renewable diesel, obviously soy oil is still the largest one, but we do see a lot of used cooking oil making its way into this equation. Now, with the recent tariffs and all the changes over there, it's likely that used cooking oil portion is going to come out, and that's what's been some of the strength in the soy oil as of late, because it's trying to have to replace that used cooking oil issue. And you can see too, back in 2021 was when the Canadian canola oil finally was allowed to qualify for that blending credit, and we started picking up some export share as well. We have seen a little bit of support in the RIN price as of late. There's been some talk about industry members pushing for higher blending mandates out of the EPA. There's no news right now as to when they could be set, but the hope is that they could be around that 5.25 million gallon mark. So on top of this, we also saw a very, very big change in the way the renewable fuel program works in the States as of December 31st. So the old program ended on December 31st. And what it used to basically mean is that for every gallon of renewable fuel that you blended, you received $1 blending credit, regardless of how you made it, what feedstock it came from, anything like that. They switched over to this program called the 45Z program starting January 1st. The 45Z program does work fairly similar with regards to a blending credit of $1. However, it is now based on the carbon intensity score of the feedstock that you use. So two big things that this changed in the industry. The first of it was soybean oil now only qualifies for about 63% of that credit, so 63 cents. So that's a big hit from the profitability side of things. And the second thing, unfortunately for us here in Canada, is canola oil no longer qualifies at all. So there are no credits available for taking canola oil and creating renewable diesel out of it. This 45Z program is still in its review period right now, and there's been next to no clarity from the Trump administration on it. And unfortunately, all of this uncertainty has seen renewable diesel production start to drop. So the RIN price, or the RIN generation, has dropped, which is going to be our gauge for renewable diesel production. You can see in the last 2 months, so it's January, February data, it is definitely backwards looking, but the uncertainty about what those tax credits are going to look like and how they're going to be applied has really got these guys backing off on production. So flipping back on the canola side of things with this, so unfortunately, about 97% of the canola oil that we export goes to the States. 57% of that goes into the renewable diesel program. So that means that program was responsible for about 39% of all the canola oil demand that we produce here. So that is a big hit to Western farmers, unfortunately, with the canola. Now, there is some positives going for the canola market. The fact that canola oil is relatively cheap on the world market, which means if we're going to have to replace our major buyer, we're in a position that we're cost competitive, that we can do so. It's a lot to replace all at once, but it at least is priced competitively to do so. The other hiccup that was obviously thrown at this market here about, I guess, a month or so ago now, was the 100% tariff from China on canola oil. They had not been big buyers of canola oil in the past few years because everything was going to the States. But before that renewable fuel program, they took about a third of it. So there's going to be some hurdles for this canola oil market to climb, but hopefully we're price competitive enough that eventually we will find those other markets. From a domestic demand point of view, so from this crush demand, crush has been, continues to run well above the 5-year highs. Obviously that trend on the left from a weekly, week to week basis, it is choppy, but for the most part, we've been above the last 5 years where we've seen. So crush is still running strong in Canada right now. Crush margins have pulled back from the highs that we've seen before, but they are still quite profitable and above the old highs that we would have seen pre this renewable fuel boom. Exports were something that I think surprised a lot of folks in this industry, and I'll admit myself included there too. Incredibly strong start to the exports this year in the fall, right? Canola prices were very, very competitive in the world, and we saw China come in and be a massive buyer of canola. Since then, we have seen this pace back off for the most part. We had a big jump about a week or so ago, so we'll have to wait and see, was that a one-time blip or is it some sustained demand? But that export market has moved, I think, better than most people thought into this marketing year. So just from a major destination point of view, obviously you can see the big jump at the start of the year was 100% driven by China. This last little bit, we've seen some better buys from Mexico and some of the other countries as well. Now, like when we talk about the beans, canola does, from an export point of view, have very big exposure to China, right? 55% of that monthly export has been going to China so far. Canola is still priced relatively competitive in the world, but we do have risk there, especially with some of this tariff news going back and forth. Something I like to keep an eye on here from a gauge of exporter, competitiveness is our spread to EU rapeseed. So if we look at that, we actually got all the way down to about $200 a ton spread to EU rapeseed. So that was a record discount. That's what kept us very competitive in the world. However, we've now moved ourselves back to 152 on the front month. And once we get past May, we actually flip and we're only about a $60 discount. The reason that's important is if we look back historically speaking, that $80 a ton discount tends to be the level where we start to see canola priced into non-traditional buyers. So anytime we get $80 below the rest of the world, we start to see buyers come to this market and buy our canola. That doesn't mean our exports are going to dry up by any means, but it is interesting that we are looking forward on deferred canola contracts going to be a lot less competitive than we have been for the last 6 to 7 months. So looking at a canola ending stocks, balance sheet number and where we think we're going to be coming into the new year. This is one that takes a little bit more playing with because unlike the USDA, StatsCan only updates its numbers very infrequently, and they're always subject to a lot of backwards revisions. So you got to have a little bit more, leeway on these numbers and some room to make your own estimates. But looking at current export forecast and crush and assuming that, we probably aren't going to sustain these levels all the way into the end of the marketing year, and based on what StatsCan said that crop size was, we're looking at about a 1.4 million metric ton carryout this year. Couple things I'll draw your attention to on that. Obviously, that is assuming that export pace slows down and even crush slows down a little bit too. I do think looking at producer deliveries for the bulk of the year and the fact that the current pace of exports and crush suggests that we would be running out of canola. I think that crop is larger than what they have on the books. So I wouldn't be surprised to see a StatsCan revision at some point in the future saying, hey, you know what? We had a bigger crop in 2024 than what we have right now. Just based on the way demand is moving and the fact that price isn't absolutely skyrocketing following projections that should take us to zero. But if we use that 1.4 number as a carryout and we use the estimated acres that we saw there back in the report earlier in the year for this year, we'll use a trend yield of about 41 bushels to the acre. It's going to bring us to a carryout of just over the 1 million metric ton mark. So that is very, very tight for a starting point of view. And, you folks are very familiar with this, that betting on a trend yield every year is a very tough bet to make. There has been a lot of growing season hiccups over the last few years. I'll make the same argument that I did with the beans and the corn, with the beans side of things, is that I would leave demand unchanged for now, but we have to be very careful that we're politically exposed on this one, right? Who knows what happens with the renewable program? There is room for additional renewable use in Canada, and we could see some policy on that side of things, but it's not going to replace everything in the short term. And then obviously the export market. Do we continue to stay quite competitive in that export market? Does China retaliate further? Those are two very, very big unknowns. But outside of that, this should provide a decently supportive outlook, at least into the spring and summer, until we know what's happening. So if we look at years, obviously with similar carryout, this puts us on a chart right around that kind of 550 floor and a 950 ceiling. Again, to get to 950, we need some type of weather scare, right? I'm not saying fundamentally we can get there if nothing bad happens this year, but we're tight enough that, hey, you know what? If we get some forecasts for drought throughout the prairies, it's not impossible. Again, assuming that policy doesn't bite us in the butt later on a demand side of things. So looking at some forecasts right now and just some retracement levels and some targets that we're working with clients here. So, the first target on this new crop canola was sitting right around that 654. Next target for sales would be 680 and 706. Now, Normally, I would be a little bit more inclined to try to wait until the 680 level before extending many sales on this canola crop based on how tight we are. But we have to acknowledge the risk of demand and the risk of policy changing. So I think it is still something that has a good starting spot for folks to start making some sales here at these levels. Seasonals remain quite supportive in this time of year, and I always like to talk to folks about this kind of price and time approach, right? So have your price targets in place that you think are realistic to hit, but know the time frame when they most likely could occur. And one of the biggest seasonal tops that we tend to see in this market can be right at the end of May. So right now we've got time to wait, to be patient on this canola, but have an understanding that if we get through the end of May and we haven't hit those price targets, it's good to have some type of plan B in place. After that, we usually get another kick at the can into July 9th. And then the last couple of years, we've been getting a pretty good kick into August when we've had some late season dryness. I'm not going to go through this slide very, very in depth here because it's going to take, we could do a whole nother call on this if you really wanted to at some point. But the strategies I like to use at this time of year and with the first price targets that we're talking about are these option spreads because they give us flexibility in our marketing. So an option spread like this would give a producer $100 of downside, but the ability to participate if prices rose another $100. So it gives you the peace of mind that, hey, I've got my downside covered. I've got some sales on the books, but if these are the lowest sales I make on my farm this year, at least I know I could still be $100 better off than what I priced at today. So I'm going to leave that as a little bit of a kind of food for thought for you folks. I'm more than happy to go through it another time, but just in the respect of everyone's time right now, I won't dive into the exact logistics on how that works, but that would be the type of strategy we're working with producers at this time of year for those reasons. Flipping over to the corn market side of things and back chatting a little bit about tariffs here. So, exports account for about 17% of total corn use. We're very exposed to Mexico on this one, right? 35.05% of our exports go into Mexico. Thankfully, trade rhetoric between the U.S. and Mexico seems to have calmed down quite a bit. Obviously, Mexico got the same USMCA exemptions, and we've kind of been out of the crosshairs as well. So I think the odds of any, renewed tariff concern affecting corn is probably pretty low, but I can never say impossible given the way policy changes across the border. Ending stocks on corn paint a different picture than the beans, right? Unlike the beans, where we were seeing growing ending stocks both stateside and in the world, we're seeing the opposite with corn, right? Corn took a big jump down year over year. Some very, very strong demand trends that we saw this year, and then the surprise drop in yield from that very dry finish knocked a lot of bushels out of the U.S. ending stocks. And world ending stocks, although still ample, they have slowly been churning down over the last 5 to 6 years. On the ethanol side of things, demand has been good, but the expansion for ethanol is pretty limited. So I think it's fair to say that ethanol use going forward probably remains strong, but there's not going to be the room for growth that we see, say, in the renewable diesel side of things. What's been the biggest driver this year has been our export pace. So corn has remained very, very competitive in the world market, and we've continued to outperform our export pace throughout the entire year. So as you can see from those basis spreads there, U.S. corn remains basically the cheapest corn in the world right now. One thing we will have to pay a bit of attention to is that we are starting to see those Brazilian basis levels drop off. They've had some better rains come through for that safrinha crop. The outlook looks pretty good going forward as well too. And we could start to lose some export business to Brazil. This is normal for this time of year when we get into their harvest May or June. It's very normal for the U.S. to then start to lose its export window, but something to keep an eye on going forward. So the weather story out of Brazil is pretty close to being done talking about, right? We're not too far away from that Brazilian harvest now. Obviously, there were some drought issues here and there throughout the year, and that chart does show a lot of red in that Brazilian growing season, but we've had enough rains come through that the prospects for that second crop look pretty good, and the forward forecasts look to continue to bring rain as well. So let's look at where this kind of pegs us for corn going into the new crop year. So obviously we saw a big jump in corn planting intentions up to that 94.4. We use a trend yield at 181. We leave demand unchanged. It's going to give us just shy of a 2 million metric ton carryout. So again, demand on this corn is going to be a wild card, but I will maybe give the nod a little bit to a lower demand bias going forward. And again, this is going to be very, very price dependent. Ethanol demand is likely steady year over year, but we are seeing shrinking livestock herds. So that could help drop feed use a little bit. And also wheat has remained very, very competitive into the feed trade from a price difference to corn. So that's also stolen a little bit of feed market value from the corn. As well as that too, total use for corn this past year is the highest on record. So to see some type of pullback from that, if prices rise a little bit, I don't think would be unexpected. So again, we'll see what these price relationships look like 4 or 5 months from now, but it's something that's on my radar that maybe we see a little bit of shrinking corn demand if prices stay up and we don't have any issues with that Brazilian crop in the next month. So anytime we've been right around that 2 billion bushel mark, it's kind of put us in a trading range of about 350 on the downside in corn and $5 on the upside. Again, I won't say there isn't reasons that we couldn't be below that 350 mark US, but I think given how supportive we are, or how tight we are in the world right now, I think there should be some good underlying support, even with the big acreage out of the States. $5 corn side of things, we're actually not too far off that right now from a new crop point of view. So there is some good value to be had on new crop right now. If we had a weather scare in the States, because we are tighter in the world, maybe we see that $5 ceiling get pushed a little bit higher. So I think that's something that we gotta go on alert for. I think that corn outlook is a little bit more supportive because it has room to get moved if we have issues stateside. Flipping over to the wheat side of things. So again, talking on exports here a little bit. On the wheat, we're not quite as exposed to any one country. It's a little bit more of an even breakdown. Our largest obviously is Mexico, but I'm going to echo the same comments that I did for corn there, that I think from the trade point of view, that side of things has calmed down. So the odds of any type of retaliation from Mexico at this time remain quite low. Ending stocks in the US have improved over the last couple of years. We've had some better crops. Obviously, the high prices that we were coming off of helped to, ration down demand as well too, and that's allowed our ending stocks to build here in the US. World ending stocks, however, continue to fall. We've had some issues over the last few years in Europe and Ukraine and Argentina, and this has contracted world supplies steadily, basically since 2019. Domestically, we had a big jump this year in domestic consumption, and this was driven by that feed trade. So as I mentioned there when I was talking about corn, the corn-wheat spread has remained very, very conducive to wheat working its way into that U.S. feed ration. Typically, anytime we get below that dollar spread, we see more and more wheat make its way into that ration. We've consistently been bouncing around that 50, 60 cent premium. So I think if that price pattern consists, I think there could be another room for even further growth in feed demand for wheat stateside. If we look at the world side of things, and actually I'm going to flip back a couple slides just for the visual, you may look at that ending stock number there and you say, okay, we've been falling for the last 5-6 years, but relatively speaking, we're still in a very, very well-supplied point of view. Well, one of the things that changed basically after 2012 was that China has started stockpiling a pile of wheat. So a big portion of those ending stocks are actually strategic reserves for China that are not available to the market. So when we want to look at the actual supply of wheat to the world, we have to strip out China. So what we like to do is look at the major wheat exporting nations' stocks to use. So basically, this is your gauge of how much supply do the major exporters have available to send to the world. And right now we're sitting just above record tight ratios once again. This in itself isn't necessarily a reason for wheat to rally, but it's a very good barometer of if something were to happen, how tight are we and how prepared are we to handle that? And right now the point is that we're not. So we still need some type of weather issue to arise, but if it does, this wheat could have the most dynamic market of any of the other ones, in my opinion. As well as that too, when we've had some issues over the last few years in Europe and a few of the other countries, Russia was able to, bang out massive crops for a couple of years in a row. So this has actually pushed more and more world demand to Russia. I always like to use the old adage, don't put all your eggs in one basket. The world has become incredibly reliant on that Russian wheat. And we've seen some issues in their crop last year, and there's some concerns about their outlook for this year. So again, not necessarily a reason for wheat to rally right here, right now, today, but it's another gauge of what could happen if there were some issues. So just highlighting some of the growing seasons on the chart here, you can see a lot of drought issues there in Ukraine, a lot in Russia, and even in the US as well too. The US has had some better rains come through. There's some forecasts for a bit of improvement as well too, but Russia continues to look very, very dry. The market doesn't seem overly concerned about it right now as we're still early in our, growing season out of dormancy. But if this persists, I think there could be some opportunity for wheat going forward. So if we look at the ending stocks, if we look at some ending stock projections for next year, if we use the planning intentions number of 46.5, trend yield of 50, it does project our ending stocks to grow to 964. Now, this is one where I think we've got to have a couple of caveats here on this, and they come down from both imports and exports. If we look at our price relationship from US wheat to the rest of the world, we are at the lower end of our ratio for what we've seen for the last few years, meaning we're very competitive in the world relative to what we've seen in other years. Typically, that's not conducive to be an importer when you have a very low price relative to the rest of the world, and it usually helps to boost our export forecast. So I do think that, unless we really see a rally in this wheat price, I think 150 on imports is probably too large, and I think the best opportunity would be some increased exports if we stay down here as well too. So where does that leave us from a US side of things if we're just looking at ending stocks? Well, in years that we've seen very similar prices, it puts us in that kind of 450 floor on winter wheat up to a 750 ceiling. I would argue 450 is probably too low given how tight we are in the rest of the world. Obviously, other years that we were down there, we had more ample world supplies. So I would say, maybe closer to $5 is some very, very good value on this winter wheat. And again, 750, it seems a little ways away right now, but given how tight we are, if we have some growing season issues in one of the major exporters, whether it's US, whether it's Canada, Russia, Ukraine, Europe, I don't think that's out off the table as well. But again, going into that knowing we need an issue to push us there, but it's definitely something that's possible if drought arises. So similar on the wheat, just looking at some near-term targets here on some of this new crop December Minneapolis wheat. 675 would be the next target I'm looking for, followed by 691 and 707. Seasonally, we remain very supportive into basically May. Most of the row crops remain pretty supportive until that kind of end of planting point. And then we usually get our second kick at the can in July, and we can get a October rally as well too. On the spring wheat, I didn't put together a strategy on that one specifically. Using those option spreads on spring wheat is a little bit more difficult because of liquidity. Usually, if a producer was looking to go that route, we would use the KC as a proxy. Again, something we could talk about at a later time too if folks are interested. But for the essence of time of the presentation, it would be a similar approach I would take for the wheat for some of these early sales, because I think we have better opportunity for upside as the year goes on. So I know I threw a lot of information at you folks in a bit of a short period of time. So if there's any kind of one takeaway slide that I want to leave you with, is just this very, very quick summary of what to watch. So on the bean side of things, current demand is decent right now. Tighter projected spring acres, it could give us some better opportunity in the spring and summer. However, record world supplies we got to pay attention to, because that's going to cap how high we can actually rally. We got to pay attention to this renewable fuel policy changes. Could be good, could be bad, we don't know yet. And obviously the risk of tariffs. Corn side of things, current demand is very strong right now. There's still enough time left in that Brazilian growing season that there could be hiccups. Shrinking world supplies should keep some underlying support under this market. Projected acre expansion in the spring is going to be huge though, and that could be a little bit of a wet blanket to this market. And again, we've got to worry about the risk of tariffs. On the wheat side of things, both tight world and major exporter stocks to use ratio is going to remain supportive. Prices are already down near at 5-year lows and some levels that are historically very good value based on current supply and demand. There are Russian winter wheat crop issues right now. The drought is continuing to take hold with very little signs of rain coming up. That narrow corn wheat spread also keeps wheat very competitive in the feed market. Upcoming spring weather is going to be a wild card. We have some drought in the States that's going to be very, very supportive to our prices, but we do know if they have a great spring, that can keep a damper on things as well too. And although the risk of tariffs is definitely lower than say the corn, beans, or the canola, it is still a risk going forward. On the canola side of things, unfortunately, I got to put this risk of tariffs, and I'll even extend that to policy changes as well too, kind of top of the list, because they're two big demand drivers that could have a very, very big shift in what this canola market looks like in the future. But if we can get past that side of things, very strong exports this marketing year. We remain competitive in the world. We've got the full growing season risk ahead of us. Again, you folks know it's no guarantee on what that prairie crop looks like and if we have any drought issues. And we are very competitive in the world, and we have underlying tight supply and demand fundamentals right now. And just circling back a little bit on kind of the methodology on those, on the importance of having these marketing dates. So I talk about have this price and time approach, right? Have those price targets in there that you feel are attainable. know when we typically see these rallies, but it's also very important to have that plan B. What happens if we get till the end of May and we haven't hit any of these upside price targets that we've got, right? You need to have some type of plan B in place. That can be options, that can be a whole bunch of different things, but have those tools in your tool belt and be willing to say, you know, what do we do if we don't get there, and how do we market our crop going from there? One last thing as well too, for any of those who are interested in some of the commentary that we put out, for our clients, we put out a morning brief every morning. Takes you about 5 minutes or so to read. It's point form. Some stuff on the macros. I write all our grains and oilseed analysis, and then a cattle and hogs. It's free to any clients that we have, but we always offer, you know what, if you want to check us out, we're happy to put you on a 1 month free trial. So anyone on the call, if anyone's interested, you know, let Dean know. And Dean, I'm sure you can let me know, and I'm happy to add folks as well too. Thanks very much for having me, folks. I'll open it up. If there's any questions, please feel free to let me know.
Great, Tyler. That was really comprehensive, and thank you for taking the time to do that. We have a question from the audience. So, if paper trading wheat is paper trading wheat a good buy right now?
I think so. Yes. So everything I'm being, you know, and obviously we deal. I always preface this a little bit because we deal all across the country, right? But for most of the Western guys I've been talking to, and correct me if I'm wrong here, Dean, your cash price is quite strong relative to where the futures price is. Like, you've got a pretty good basis right now. So I think it's providing a very, very good opportunity to clean up any old crop sales or anything you've got on the books and re-own it on paper to take advantage of the fact that the futures have quite a big discount. So yeah, we've been buyers of wheat off and on. Spring wheat, basically $5.90 to $6. We've been picking away, owning it. We did pull off a bunch of lengths start of the week on a basically wetter US forecast. We were able to kind of get out and we're repositioning back in. But I think owning it on paper at this time of year and given the price levels, offering some pretty good value.
Yeah, so that was my question. Trevor Sherman here. I trade with Phil on you guys. Yep. The one strategy I have with my marketing guy and using you guys is there's some pretty good wheat basis right now for old crop, like 15 cents.
Yep.
So I'm pretty heavy into that. I basically have most of my production locked in that basis. Is it still make sense to double play it, basically play the physical and paper trade double down?
I'm gonna from a purely fundamental point of view, if I'm ignoring risk or anything like that, I think it does. But every individual's got their own risk tolerance, right? So you might be comfortable with that risk. You know, another guy on the call might be, you know, I'm not comfortable with that at all. But I think from an outlook point of view, I think it's a good idea to be owning some wheat here. And I think there's some pretty good opportunity throughout the spring, summer. Comes down to individuals' comfort level, whether they want to make sure they've got all their sales cleaned up first or not. Speculate a little bit both. I mean, you know, I would say, you know, talk to Dean and these guys right from a basis outlook point of view. I mean, that basis has been incredibly strong. Do we think it's going to get much stronger? I don't know. So it might still be worth cleaning up anything you have left and then re-own it on paper. And then circling back a little bit actually to a point that Andrew had there, and we've had these conversations a number of times over the years, that, you know, storing your grain isn't free, right? Especially with where interest rates are right now. So a lot of the time you can move this stuff and then look at some option spreads for cheaper than what you're paying in interest month over month to re-own this wheat. So it's another thing to kind of think about as well too.
Great, thank you for that. Yeah, relating to the oilseed side of things, and you were talking about the 45Z. I know the canola growers of both Canada and the US are working very hard to try and educate on how the carbon sequestration component of what canola is going to do as an offset to the carbon generation and all that stuff. So I guess we'll see, you know, and like you said, it's a bit of a wild card for now, which again, so it's a holding pattern, and lots of assets have been paused with built out for the time being. Does anybody else have any other questions for these fellas? Perfect. Well, what I'm going to do, thank you very much for that, guys. I'm just going to pause the recording. What I was going to say was, if it's all right,